All right, let's get into it. Today, we're stepping into the ring for a real heavyweight bout between the world's two largest stock markets, the United States and China. We're going to break down the key differences between these financial titans, from how they're built to how they actually behave. So let's get ready to rumble. So here's how we're going to break this down, kind of like the rounds of a fight. First, we'll start with the tail of the tape, just their sheer size. Then, we'll get into the rules of the game, who's actually in the ring, their fight history, the role of the referee, and finally, what this all means for an investor. Okay, round one, the tail of the tape. Before we get into all the different styles and strategies, we just have to get a sense of the sheer size and weight class of these two champions. So let's be clear. The United States is the undisputed heavyweight champion of the world. The U.S. stock market is so massive that it accounts for a staggering 40 to 45% of the entire global stock market value. It's the biggest, deepest market on the planet, period. But you can't ignore the challenger in the other corner. China's onshore A-share market alone is worth around $9 trillion. That makes it the clear number two in the world. And what's really interesting is that it's increasingly where China's new economy companies, tech and healthcare, are choosing to list their shares. Now for round two, the rules of the game. See, these two markets don't just differ in size, they're built on totally different blueprints. And this creates two very, very different rings for investors to compete in. Just look at how different the daily experience is. The Chinese market literally takes a 90-minute lunch break in the middle of the day, and stocks there have a 10% daily price limit, meaning they can't go up or down more than that in a single session. The US market, it just trades straight through, and there are no limits like that, which allows for some of those huge single-day moves we sometimes see. And here's something you've got to understand. Investing in China is way more complicated than it sounds. You can't just buy one type of Chinese stock. You've got A shares for domestic investors, B shares for foreign investors, and then H shares, which are Chinese companies listed over in Hong Kong. Each one has its own rules and its own level of accessibility. A market's personality is really just a reflection of the people trading in it. So who are the dominant players moving prices in the US versus China? The answer to that reveals a huge psychological divide between the two. And this might be the single biggest difference of them all. The US market is overwhelmingly driven by big institutions. We're talking mutual funds, pension funds, ETFs. But in China, it's the complete opposite. The day-to-day trading is dominated by millions of individual or retail investors. And that difference in who is trading leads to a huge difference in how they trade. U.S. institutions tend to focus on things like company earnings, long-term fundamentals, and systematic strategies. China's retail investors, on the other hand, are much more reactive to sentiment, to big policy announcements, and to speculative story stocks. And what you get is a market with much higher trading volume and a serious tendency to chase momentum. All right, so let's look at the historical scorecard. We've seen how they're built and who's trading them, but how have they actually performed over the years? Let's compare their track records over the past decade. Yeah, when you look at the last 10 years, it really hasn't been a close fight when it comes to returns. The S&P 500 has delivered a pretty powerful 13.8% return each year on average. The MSCI China Index, while still positive, has lagged behind quite a bit at 7.6%. But returns are only half the story. This chart shows the volatility, basically how wild the ride was. The US market's path, that blue line, has been relatively smooth. China's path, in orange, has been a total roller coaster with much more intense and unpredictable swings. And that volatility isn't just random. It actually reflects a pretty distinct pattern in the Chinese market. It's a history that's really defined by these dramatic boom-bust cycles, periods of incredible gains followed by staggering losses. I mean, just take the boom year of 2020. The MSCI China Index shot up an incredible 29.7%, just crushing global averages. But then, the bust followed very quickly. Just 2 years later, in 2022, that same index plummeted, losing nearly 22% of its value. And then, the cycle just repeats. This kind of whipsaw action makes it an incredibly challenging market to try and time correctly. This chart gives us another way to see the difference. If you look at the US market's monthly returns on the right, they're skewed positive. There are simply more up months than down months. Now look at China on the left. The returns are much more symmetrical, meaning the odds of an up or down month have historically been much closer to a coin flip. Okay, now we have to talk about one of the most critical factors, especially for China, the role of the government. In this ring, the referee isn't just a neutral observer. They can, and they often do, directly influence the outcome of the fight. In the US, policy risk is usually transparent and big picture, right? Like when the Federal Reserve announces interest rate changes. But in China, it's a completely different beast. Policy risk can be sudden, it can be targeted at specific companies or entire industries, and it can include direct intervention, like ordering state funds to buy stocks. So, after weighing the structure, the psychology, the performance, and all the policy risks, what's the final verdict? What should a global investor take away from this whole heavyweight comparison? Well, a lot of the time, the decision comes down to price. On a forward-looking price-to-earnings basis, the S&P 500 is trading at a multiple of over 24, which is pretty high compared to its own history. The CSI 300, which represents China's big companies, trades at a much lower multiple of around 16. That discount? Well, that's basically the market's way of pricing in all those extra risks we just discussed. So the takeaway here seems to be a two-step approach. For most long-term investors, the U.S. market, with its stronger governance and more stable returns, should really be the core of your portfolio. Then, you can think of China as a smaller, satellite position, a more tactical bet for those who can stomach the risk and want exposure to its higher growth potential. And that really leaves us with the final multi-trillion-dollar question, doesn't it? As China's markets continue to evolve and open up, will their behavior start to look more like the stable, institution-driven U.S. market, or will the hand of government policy always be the dominant, unpredictable force in the ring? That is the big question.